going on, folks? A little bit better there. How's everybody doing this morning? All right. If it's your first time joining us, if you have any questions about any tickers, any currency pairs, anything you want us to break down live with you, just let us know in the chat. Or if you just have questions about trading in general, fire away in the chat and I'll do my best to answer them for you guys. All right, let's look at SMCI. So whenever we start our analysis, guys, we always start from a top-down analysis, higher time frames first. The reason we valorize higher time frames is because they do tend to be more powerful than lower time frames. This is SMCI, brother. So here I am on the monthlies for SMCI, and what I'm looking for first before anything else is institutional order flow. I'm looking for areas where banks, hedge funds, financial institutions have bought and sold here on SMCI. So do I have any clear institutional order flow? Well, I have this nice continuation right here, impulse, balance, impulse. Some big banker institution bought heavily here, driving price action upwards explosively on SMCI. Can everyone see that structure there? Now, how do I know this is a banker institution, guys? Why is that a bank that bought right there and not you or I? Why couldn't that just be us reacting to some, whatever, market news or something like that? Why is that more likely to be institutional? What do you guys think? Yeah, it's a big imbalance. Oh, what's up, Garrett? How you doing, brother? I'm sorry to hear that, my man. Some days are like that, man. I'm feeling better. I don't sound great yet, but I feel better. Slowly but surely getting better. It was a rough cold, man. Yeah, it's a large imbalance in order flow, CK. This is a large imbalance. For you to cause price action this impulsive, you have to be placing a very large order, right? And it just comes down to the magnitude of what causes price action. Like, what is price action at the end of the day when you're looking at the financial markets, guys? All price action is simply an imbalance in order flow. If there are more buyers and sellers, that's going to cause price to go up. If there are more sellers and buyers, that's going to cause price to go down, right? It's just economics 101. When you have equal numbers of buyers and sellers, you have consolidation. You have small-bodied basing areas, periods of equilibrium in the market. So if you look at this from that perspective, what you're really seeing here, yeah, it was a bad cold, man. But I feel much better now. I'm feeling better today. What you're really seeing is you're seeing buyers were in control, pushing price action up. There was a period of balance here for a brief period of time. Buyers were buying, sellers were selling, and price wasn't moving. But eventually there were so many more buyers and sellers that every single seller was exhausted, and all we had left was buy orders. And when you have an imbalance in order flow, more buyers and sellers, that causes price to go up. Now, the reason we're interested in these levels where banks have bought and have sold is because when banks place orders, they're placing such large orders that not only are they creating imbalances in order flow, they're also leaving behind unfilled orders typically at those levels, right? Because they're not trying to buy hundreds or thousands of shares like you or I might. Banks are dealing in millions of shares, millions of contracts, millions of lots, right? And when you place orders of that magnitude, it normally takes banks months, sometimes years to fill their orders because they're not buying small positions, right? If I'm, State Street, and I see an opportunity to drive price action here in SMCI, and I position size out to buy 20 million shares of SMCI at 24 bucks, at that limit price of 24.93, that's a big substantial order. Now, just because State Street wants to buy 20 million shares at 25 bucks, does that mean there's going to be 20 million sellers conveniently sitting there waiting for them right at that limit price? Well, that's very, very unlikely, right? So what happens to financial institutions is they place these orders and they fill some of their order. And that's what you're seeing when you see the equilibrium. You're seeing orders being filled, right? Buyers are buying, sellers are selling, prices are moving. But eventually, they exhaust all sellers. And when they exhaust all sellers, all they have left is unfilled orders left over. And when you have that imbalance of more buyers and sellers, that causes price to move out. More importantly, it leaves State Street behind with unfilled orders. So if you want to think about it mathematically, let's say they wanted to buy 20 million shares here. They place this limit order in the market to buy 20 million shares. But when they place the order, there are only 5 million sellers available at that limit price. So how much of their order can they fill? 1/4. They can only fill 5 million of the 20 million that they want, right? You can only buy what's available. You can only sell what's available. So they buy the 5 million and they eliminate every single seller at this limit price. But now State Street has 15 million unfilled buy orders sitting there. So now they have 15 million buy orders, 0 sellers left. That's going to cause price to go up. And it's going to leave State Street with those 15 million unfilled orders. Now, a question a lot of times people ask me is like, well, why won't they just cancel the order? And this just comes down to, why were they position sizing out 20 million shares in the first place? If they were position sizing out 20 million shares, it's because they want 20 million shares. It's because that is a quantity of shares that makes it a worthwhile investment for them, right? So think about it more from their perspective. Is State Street shocked that they couldn't fill their full order at once? Well, no, that's the norm. That's the nature of trading as an institution. It normally takes banks months, years to fill their orders. So they're not shocked by that. They never expected to fill their full order at once. So why would they cancel the rest of their order? Right? Everything so far is going according to plan with the way they trade. They filled 1/4 of their order, price shot away. And now they're left with these other 15 million unfilled orders. Now, this is where we as the small guys have an advantage where we can take advantage of their deep pockets and we wait for price to come back into this level so that we can buy with State Street. Does that make sense? Can everyone see how when price comes back in, it hits the unfilled orders, it gets pushed out, comes back in, hits the unfilled orders, gets pushed out, comes back in, hits the unfilled orders, gets pushed out? Because in this green area, there's still all those unfilled orders sitting there. There's an imbalance in order flow of more buyers and sellers. So when price comes back into this level, it hits those unfilled buy orders and gets pushed back up. More buyers and sellers, price gets pushed up. And that's where we're looking to get into a trade, guys. That's where professionals look to get into a trade. We identify the order flow, but we don't chase the imbalance. Instead, we wait for price to come back so that we can take advantage of the bank's deep pockets and buy together with the financial institutions. Up here on the sell side, we have this area of institutional selling as well. Impulse, balance, balance, impulse. Beautiful imbalance driving price action down. Some big banks sold heavily here, driving price action downwards explosively on SMCI. But when they sold, did they fill all their sell orders? Again, they couldn't have filled all their sellers because if they'd filled all their orders, price would have continued to consolidate. When you have equal numbers of buyers and sellers, price consolidates. But we have imbalance. So the fact that we have this massive impulse out tells us as analysts that there's an imbalance of more sellers and buyers here, driving price action down and likely leaving behind unfilled sell orders up here at this level as well. It's a very broad zone, so it's not the type of zone we ideally want, but we're going to be drilling down to lower time frames to try and refine that structure as well. Everybody with me so far? Give me a yes or like in the chat if that makes sense to you so far, the concept of how professionals approach the market. We identify areas where major banks and financial institutions are buying and selling. We do not chase the initial impulse caused by them. We don't chase price action like retail traders. Instead, we have the patience to wait for price to come back to these levels to then evaluate if we have an opportunity to buy together with the financial institutions. That's all we're trying to do. We're just trying to buy with the banks and sell with the banks. I don't want to fight the banks. That is a waste of time. We do not have the capital to fight the banks. We just want to join their team. Awesome, awesome. All right, so here we are on the weeklies, and the first thing I'm going to evaluate on my intermediate time frame is my trend. What is my trend here on the weeklies for SMCI, guys? Is this an uptrend, a downtrend, or a sideways moving trend? We can do Tesla. Let me just finish here with SMCI, and then we can do Tesla. Sorry, it sounds so terrible, guys. What's that trend, guys? Is this an uptrend, a downtrend, or a sideways moving trend? You can tell me in the chat. What do you guys think? Yeah, it's still a downtrend, right? Test? What are you testing, Sam? Yeah, this is still a downtrend. So what does that mean for us as retail traders? Well, that means ideally we would like to go short. We would rather trade with the trend than against the trend because trend trades are higher probability trades. Now, that doesn't mean that we never take counter trend trades. It just means we have a preference for trend trades because they're higher probability trades, right? If we're going to take a counter trend trade, then everything else in the trade has to be pretty much picture perfect for us to be willing to take a counter trend trade. So we defer towards trend trades, but it doesn't necessarily mean we'll never take a counter trend trade at all. All right, so now that I have my trend, what do I need to evaluate? Same thing. I'm looking for order flow. Where are the banks buying? Where are the banks selling? All we're trying to do is trade together with the financial institutions. They're the ones who control the markets. So we just want to join their team and buy where they buy and sell where they sell. Do I have any clear institutional order flow here on the weeklies? Well, I have this beautiful reversal right here. Impulse, balance, impulse. Nice area of institutional selling. It's really a continuation because there's a slight gap. Beautiful imbalance, right? Some big bank institutions sold and sold heavily here, driving price action down. What's a negative to this zone that you guys can tell me? What's something I don't like about that zone? Right? It's great strength and movement, broke past oppositional again, very little time spent. What don't I like about it though? Because there's something I don't like about it right there. Can everyone see it? What's the problem with it? Do you see how we gapped out from the close here to the open here, and then we came back in and hit? That gap matters. You can't ignore that gap. That is an imbalance that's occurring outside of market hours. That is like us having an impulsive candle. And even though it's a small area, it still counts as an impulse out. So now, this coming back in, that is the first hit. That's the first retracement back to the level of imbalance. So that is the first time we came back in and hit those unfilled orders. So we came back in, we hit that huge pile of unfilled orders. Oh, trying to make this a little smaller. And reacted out of it. Does that make sense? I'm seeing your comments, Dan. Exactly. The purity isn't there, right? It's not the purity we're looking for, Joe. Doesn't mean this zone is negated. It's not dead to us. We prefer to be there in the first hit. That's our ideal situation. First hits are the highest probability trades, right? That's where you have the largest amounts in order flow. But it will change the type of entry we would look at if it traces back to the zone. I would no longer be looking for a limit order here at the bottom of the zone. Now I'd be looking for a zone entry. I'd be looking for a reversal within the zone before I would consider taking the trade short. All right, so it's just going to change my entry. Why do our entries change when we retrace to levels, guys? If I've already tested a level, why do we have to change our entries? What's the reason for doing that? Because this is an important thing to reflect on when you're trading. It's not just for fun that we do that sort of stuff. Oh, I need to turn magnets back on. Hold on a second. Oops, how did I do that? Didn't mean to do that. Magnets. There we go. Now I got my little demand right here, a little area of institutional buying. So what's a reason for you to change your entries if you retrace to a level that's already been hit? Because there's a very strong reason for it. Can everyone see this? Impulse, balance, 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 impulse. So we have a nice continuation pattern. Some big bank bought here driving price action up. And this one looks like that came very close to hitting and reacting. That's a very close wick in there. What's the low here? 30.58. What's the entry here? 30.44. I would consider that a hit. I would consider that a hit because that is way too close and we reacted very dramatically off that level. So I would make that adjustment on the zone because realistically, guys, is it possible that when we're doing chart analysis, we can be off by a few pennies? Of course it is. We're just doing chart analysis, right? We're not sitting in the meetings with determining actual specific entry points for the banks. And that's a dramatic reaction. So this to me is already a hit. It hit the unfilled orders and popped back up. And that's where we have to use common sense in what we're doing, right? So what's a reason? Leftover orders are triggered. Yes, that's one reason, Joe. But the main reason is this. When you're trading in the financial markets, who is your opponent? Who are you actually trading against when you trade in the financial markets? You're going up against major financial institutions. And that's something a lot of times that retail traders don't understand about the financial markets. They think of the financial markets as a level playing field. They think of it as like, well, I have as good a shot as anybody, Mr. Black. You know, I have some money, and if Bill from down the street can make some money trading, I can make some money trading. It's like, yeah, kind of, because your real opponents are the financial institutions. That's who you're actually trading against, right? When you hear statistical data of 97 to 98% of retail traders lose money over time, think about it in a different perspective. For every buyer, there's a seller. For every seller, there's a buyer. What does that really mean? That means in most cases, the market's going to be zero sum, which means for every winner, there's a loser. For every loser, there's a winner. Now, there are only two major players when it comes to the financial markets. They're the retail traders, which are you and me, and they're the financial institutions. If 98% of retail traders lose money, where's that money going to? It's going to the people on the other side of the trade, which for the most part are the financial institutions. And that's one of the things that people always need to understand about the dynamics of the financial markets. Banks are not passively trading alongside you. They are actively actively trading against you. Over 80% of the profits that banks make in the financial markets are off of retail traders. So they are very actively invested in where retail traders trade, right? They will target levels where retail traders trade. So when I have a level that's already been tested, what am I starting to form in the world of retail traders when I have a pivot reversal and then I have a retest of that pivot reversal? What did I just form in the eyes of people who learned off of here, the big red button? What am I starting to form in their worldview? People whose level of education and trading is limited to online websites, like the one we're on right now. You know what I'm saying? I'm trying not to say the name because I don't know if they get mad if you say the name. Well, more importantly, I'm starting to form something that retail traders love, which is what they call resistance. Does that make sense? Yeah, it's definitely a sell zone, exactly. I'm starting to form resistance in the eyes of retail traders. Now, if I'm forming a level where a lot of retail traders will be attracted to take a position, right? Now, retail traders with minimal amounts of knowledge are going to be excited about this level. They're going to be like, oh, I watched a YouTube video that told me about resistance. I know what I'm supposed to do with resistance. If price comes back to resistance, I'm supposed to sell, right? If banks know how retail traders trade, and almost every retail trader trades the same way, right? YouTube University, so on and so forth. Oh, I just said the wrong word. Either way. And they have enough money to move the market. Can they purposely push price through levels where retail traders are trading just to knock them out and take their money? You better believe it. Not only can they do. They do it all the time, right? And that's why you'll so often see, who's seen this before, at levels of support and resistance where price comes back and it does a deep wick through the level before reversing and coming back down. So it doesn't break the level, but it deeply wicks through. Who's seen that happen on the charts? Where you see a level of support and resistance where it really deeply wicks, but then it turns and the candle actually reverses out of the level. It happens all the time, And retail traders are always like, man, I swear, it's like the markets are out to get me. It's as if the markets are targeting me personally. Anytime I place a trade, it's like they know where I'm going to place the trade. And they just knock me out of the trade, take my money, and then it goes and shoots off in my direction, right? That's what people say, right? They say, like, I swear, man, it's like the markets are out to get me. And it's like, they are. If you're going to trade in the same way that every single retail trader in the world trades, well, there's a reason there's such a high failure rate. Right? 98% failure rate is not random. It's because almost everyone does the exact same thing. Retail traders all tend to trade the same way. They learn basic concepts of technical analysis. And if you don't know what I mean by basic concepts of technical analysis, I mean exactly this sort of stuff. Support, resistance, moving averages, Fibonacci retracements, volume, MACDs, VWAP, candlestick patterns, Ichimoku clouds, RSI, momentum, or they follow the fake gurus, the fair value gap garbage and all that stuff, and they start trading off this stuff, and they go, man, it doesn't work consistently. I keep losing money over time. And it's like, well, you're trading the same way every single person in the world trades. And if you're going to trade the exact same generic way that the majority of retail traders trade, they have a 98% failure rate. You got to learn to trade the way the financial institutions trade. So this is why we change our entries, because we know this right here will become a potential target for banks to do a liquidity trap, where they will purposely push price through levels to knock out retail traders, take their money, and then allow price to come back down. So by changing the type of entry we place here, if price should retrace back, that's how we're trying to avoid those liquidity traps, right? We're giving ourselves a better fighting position where we're not going to be in the position for that liquidity trap should it occur. Now, it doesn't mean that the bank will necessarily create a trap here, but that is the type of level where they like to create traps. Is everybody with me on that? Give me a yes or a like if that makes sense to you. So we change our entries accordingly because we understand that banks will start trapping at certain levels where retail traders trade, and we want to avoid those traps. Doesn't mean the price can't reverse. This is still great strength and movement, but we're going to use a different type of entry for that reason, to avoid those traps. So we're going to wait for the reversal before looking for an entry there. So there we go. We got our weeklies. Let's drill down to the dailies, and this is where we're going to look for an actionable trade on SMCI if there is one. We'll see if there is anything actionable here. And I do have an interesting little pivot reversal right here. I'm going to take away the circle just so we can see it, so you guys can see it clearly. Right here, I have this impulse, balance, impulse, pivot reversal. So you can see right here, we have this little area of institutional selling, and that is daily, weekly correlation. Not only that, but can everyone see this gap now? Now that we've drilled down to the lower time frame, this is why we're always looking at multiple time frames, guys. What's this gap right here? This is an impulse balance, impulse pivot reversal with a gap right here. What type of gap is that? That's a gap that matters to us. That's a breakaway. That's a breakaway right there, right? Indicating a strong imbalance in order flow. So now, I know this trade's already happened, but this is a good example of the type of trade we like. If we were here when this was happening, if we were paying attention to this when this was happening, right? This is the type of trade that interests us, because now I have daily, weekly correlation, zones on top of zones, and we love zones on top of zones, right? They form stronger levels of imbalance. If I have multiple banks and institutions selling at or near the same price point, the area in which their order blocks overlap, this darker area, has an even stronger level of imbalance. It's like I'm forming a Venn diagram of unfilled orders. And I have a breakaway gap indicating a strong imbalance in order flow pushing price action down. So this first retracement back here, that is a first retracement to multiple time frame correlation with a breakaway gap. And for those of you who know me, that's one of my favorite types of trades to take. I love taking that first retracement back to multiple time frame correlation with a breakaway. That is literally my favorite type of trade to take in terms of a setup. I like it even better when we have monthly, weekly, and daily correlation. But anything dailies or above where we have multiple time frame correlation with a breakaway, those rarely don't work out, and they are often triggered immediately. So there's one of those things where when I go and go through my watch list every morning, I will filter out if I have any breakaway gaps that give me an opportunity for potential immediate trade during that day. Does that make sense to everyone? And if you took that trade, that was a good trade. You had a nice reaction out of it. Now it's too late. It's already happened, right? That one's done already. On the buy side, do we have any order flow? Yeah, that's an area of institutional buying right there. There's definitely institutional buying happening right there. Oops, got to turn magnets back on. I keep turning them off and on and off and on. There we go. So there we have institutional buying. We're going to mark that green for institutional buying. It's pretty good strength of movement. We did manage to break past the oppositional again. Very little time spent. I don't love the way it's structured, but it's not too bad. That's a potential opportunity to go long if price should retrace back down to 42.30. Potential opportunity to go long. As always, with any sort of trade setups, guys, do things at your own discretion. Of course, there's a lot more analysis that goes into this beyond this. Your comments are being shown, San. I can see your comments. What's up, Johnny? How you doing, man? All right, so that's what I got for you on SMCI, man. Up here, potential zone entry if price retraces back up to this area of multiple time frame correlation at 61.32. And then here, potential limit at 42.30 to go long. All right, in both cases, have to see how price retraces to see if that affects our risk-to-reward ratio. I'm doing all right, brother. Getting slowly better, man. Cold, starting to recoup. I didn't even take any cold medicine today, so I feel better. We can look at NQ. Let's go check out NQ. So I don't sound great, but I'm feeling better. All right. For those of you who don't trade futures, futures is more of a day trading asset. So we are going to be drilling down to lower time frames. Despite me drilling down to lower time frames, guys, I do encourage you to take the time to still go and look up at the higher time frames anyway and mark off those higher time frame levels, right? You don't want to ignore those monthly, weekly, daily levels. Even if you are just trading on like 5-minute, 50-minute candles, you still want to mark off those higher time frame levels because they do tend to be more powerful. And the last thing you want to be doing is like going long off of 5-minute candles and trading right into, let's say, monthly, weekly, daily selling or something like that, right? You want to be sure you're protecting your downside, taking trades that are good in terms of higher time frame structure as well. All right, so here we are in the hourlies. We're going to start looking for the same thing we always look for, which is institutional order flow. That is not quite a basing candle, but this is strong impulse in, strong impulse out. It's on the edge. I'm going to mark it off, but I bet you we're going to refine this zone better when we drill down to a lower time frame. So we have institutional buying here, impulse, balance, impulse. Some big maker institution bought heavily here, driving price action up, but I bet you we will refine this better when we drill down to the 15s. On the sell side, we're tentatively setting up an area of institutional selling right here. But this candle is, of course, still active, so we can't count it yet. Let's go back in time, see if we have any good structure anywhere. That's not too shabby. Look at that. Impulse, balance, impulse. Beautiful level of institutional selling right there. Some big bank or financial institutions sold and sold heavily, driving price action downwards explosively here on NQ. Beautiful imbalance and order flow. And we haven't touched it, but boy, have we come close. What's the high here? 2267.25. What's the entry here? 272. We haven't touched. Oh, we did touch it here. Sorry, we did hit it. Pardon me. I didn't realize we had hit the unfilled orders. Well, it's nice to know why it reacted, right? Does everyone see how we came back in, we hit those unfilled sellers and immediately reacted out? Now you know why it turned where it turned. So we have institutional buying, institutional selling. Our supply zone has already been hit once. We're going to drill down to the 15s. And what I'm looking for in the 15s is I'm looking for trend and I'm looking for correlating structure if there is any. So here I am on the 15-minute time frame for NQ. First thing I want to evaluate is what is my trend here on the 15s? Is this an uptrend, a downtrend, or a sideways moving trend? And be careful because we just had an interesting little change there. What is that trend? Up, down, or sideways, guys? You guys tell me in the chat. So it's very reasonable to think up, right? Because you had higher highs, higher lows. But if you look, this candle right here closed past our controlling higher low. Do you see that? We closed past this. This was our controlling higher low right here. That was the control. And we just candle closed past it. So we actually just ended our uptrend. Because what's the definition of an uptrend? Uptrends are defined by establishing higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, right? I can't have a lower low with an uptrend. So the moment this red candle closed, our uptrend ended. Where did the uptrend officially end? Well, it have ended at the last control point, which was right here. That was the controlling higher high. So since then, what have I had happen? I've had an impulse and a correction. And an impulse and a correction on their own are not enough to establish a new trend. I need at least 3 clear segments of movement. So right now I am directionally neutral. I am consolidating. I'm neither bullish nor bearish at this point in time. Yeah, it just takes practice, Sam. Absolutely, man. Is everybody with me on that? Does that make sense why it's now currently non-directional? It is currently consolidation, sideways moving. Oh, you got it right, Sam. You got it right. You said sideways. Cool, cool, cool. Everybody with me on that? So what does that mean for us as retail traders? It just means we don't have a bias. We could go long or short depending on the opportunity that presents itself. Now, what are we looking for? The same thing we're always looking for, order flow. Where are the banks buying, where are the banks selling? We have a clear continuation pattern right here. 15-minute, 1-hour correlation right there. Nice little zone on top of zone structure. We have another continuation right here, but it is a green, green, green continuation on a 15-minute time frame. So in this case, because we're on such a low time frame, what I need to do is I need to drill down to a lower time frame. I'm going to drill down to the 5-minute. And I want to see oppositional structure here. I want to see a fight between buyers and sellers where buyers won. So when I drill down to the 5s, what I need to see here to justify this zone and make it a viable zone is I need to see red candle pushback. So let's go down to the 5s and see if we have red candle pushback. We can see we have a red candle pushback. So we do have a fight between buyers and sellers where buyers won. It doesn't help our zone tremendously though, because what we're really seeing is we're seeing this continuation and the retest of that continuation pattern. Can everyone see that? Impulse, balance, impulse right here. That's the continuation. That is the retest of the level. You can actually see how price turned right where, here, let me take this massive circle out of the way because now it's just in the way. Right where the two zones overlap each other. Can everyone see that? Right in that little overlap. Hit those unfilled orders, more buyers and sellers. Again, massive, massive circles for some reason. Doesn't need to be quite that big. There we go. Hit that big pile of unfilled buy orders and shot up. So even though we're refining the structure and then we're validating that this was a valid zone on the 15-minute time frame, we're also showing that we've already hit the unfilled orders. We've already hit that order, right? We've already hit the 5-minute, 15-minute correlation. So even though it's a valid zone, it's not good in terms of purity. We've already hit it once. And for me, especially when I'm trading on low time frames, like 5 minutes, I personally don't hit trade zones more than once. if they've been hit already, as far as I'm concerned, all futures trades on 15-minute, 5-minute time frames to me are one-hit wonders. It's one hit and done. I don't look for multiple hits to zones of this nature because low time frame zones tend to be broken very easily. So like I like that first hit with multiple time frame correlation and then done. Standalone fives like this, like you can see, we came back in. This was institutional buying over here. Some bank bought heavily here, driving price action up, leaving behind unfilled orders. Price came back in, hit those unfilled orders, and popped back out. But I would never have taken that trade because that's just a standalone five. It's not strong enough on its own for me to be willing to take that trade. Thank you, Willen. Yeah, slowly but surely, man. Slowly getting better, right? Same thing with the supply zone. It's a beautiful, strong imbalance. Beautiful, strong imbalance down. Obviously, strong imbalance. Broke past the oppositional again. Very little time spent. But it's just a standalone five, guys. Standalone fives are broken all the time. So don't put a lot of faith in standalone 5-minute zones because it's not as much capital to drive price action on a 5-minute candle. Does that make sense? It just doesn't require as much capital to drive that level of price action. So I like when you have the multiple time frame correlation. The only other level where we have multiple time frame correlation is this one down here. Here we have the 15-minute, 1-hour correlation, and here's the 5, right? Impulse, balance, impulse, 5-minute correlation. So we do have, we do have the 5-minute correlating structure right there. That is 5-minute, 15-minute, 1-hour correlation. Zones on top of zones on top of zones. What's the problem with this level, though? What's the problem with it? Looks great, right? Everything we want in terms of a zone. 5-minute, 15-minute, 1-hour correlation. Multiple time frame correlation. But already got hit. Can everyone see how we impulsed out, came back in and hit it right there? That's the time. That's when you take the trade. And this is the only downside I would say to futures trading for those of you who like day trading. Day trading is very cool. It hasn't been broken. Still valid. It's not that it's been broken. It's that it's already been hit. The big problem with day trading is you got to be there, right? Because trades will set up. I mean, think about this. This trade set up at 9:35 a.m. and then it was triggered at 9:45 a.m. And if you were there from 9:35 to 9:45, you could have taken the trade. If you weren't there from 9:35 to 9:45, you missed the trade. It already happened. It was a good trade. It was a great trade. Look at this beautiful impulse out. It went all the way up to supply. Like, that's exactly the type of trade I like. It's what I was saying to you. First hits back to multiple time frame correlation. That's the only type of trade I like to take in futures. If I trade futures, that's the only one I like to take. But it's very fast moving, so it's like you kind of have to put the time in. That's why a lot of futures traders will be there for an hour or two just trading. That's a 12-to-1 that you could have gotten this morning. Just following basic concepts of order flow, right? Just like being selective, saying, hey, I'm not going to take any of these fives. I'm not going to take this other 5 here. I'm not going to take the 15-5. I'm only going to take 5-hour, 15 and hourly. I'm going to take the multiple time frame correlation first retracement. If that was the only trade you took today, that was a good effective trade that you could have taken in futures, right? Being a little selective with the trades you take can give you better returns than trying to take more trades throughout the day. Because yeah, this still gave a bounce, this still gave a bounce, but neither of these trades are good enough in quality for me that I would take them. The only one I would have considered taking was that one. Is everybody with me on that? Give me a yes or like if that makes sense to you in terms of being selective with your futures trades, especially when you're a day trader. The more selective you are, probably the better it's going to be for you down the line. It's one of the reasons, even though I ironically don't really trade a lot of futures, it's one of the reasons I'm a pretty good futures trader is because I don't feel forced to take a trade. Why? What's over to the left? What am I concerned over here? This wouldn't concern me. I'd just take profit along the way, brother. I mean, we got to think we have enough. This is such tight structure that you would start. I would say you should still manage a trade if that's what you're saying. Like manage a trade accordingly, of course. But this is just a standalone 5. I'm not worried about it. This is what I was saying to you. Standalone 5s are not particularly powerful, right? That's exactly great. It's a great example of what I mean by standalone 5s aren't that powerful on their own. It's a beautiful imbalance, but it's just a standalone 5, right? So when price shot out here, you can even see it reacted to it before we would have gotten triggered. That was the first hit. So it came back in, hit the unfilled orders, and then the second hit, what happened? Just right through that supply zone. So we wouldn't have been concerned about that supply zone because we would have been getting in here after it had already been hit. Does that make sense? So that wouldn't have bothered me at all. And yeah, there are other levels. Of course there are other levels. It's futures. There's going to be so many levels all the time everywhere. But is this level going to concern me? It's a retest of this, which is 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 a retest of this. It's like they're all beat up, right? Now, what you can do to manage the trade is start taking profit along the way, right? You take your entry here. When you come out, and let's say you hit this first supply zone target. Let's just pull this back. You hit this first supply zone target right here, right? What is that? At that point, you would have been at a 2-to-1. That could be a point where you take some partial profit, right? Shave off some of your contracts, take some profit, move remaining stop losses up to break even or to TP1, right? And now you have runners going. And then as you start going up to the next supply zones, shave off a little more position, lock in some more profit, but still leave some runners for the further higher time frame target because we know these 5-minute zones are not as powerful. Does that make sense? So that's a way to manage the trade, start locking in profit along the way. Cool. Awesome. All right. I'm going to hop over to the TikTok, guys, but for those of you on YouTube, if you want to learn more about trading, I'm teaching a free workshop Thursday, 7 p.m. Eastern. You can register for free on our website, TradePhantoms.com. Just click this purple register here button on our website, TradePhantoms.com, and it will give you everything we're going to be covering in that workshop. We're going to be doing deeper dive in all these topics. I'll teach you more about how the markets really work. I'm going to be teaching it myself this week, so you will be in my very capable hands. We'll teach you more about how we identify institutional order flow, where the banks buy, where the banks sell, so we can buy and sell together with the financial institutions, how to trade in all market conditions, whether the market is bullish, bearish, or consolidating, how to use leverage properly so you can reduce the amount of capital you're trading with, reduce your risk, generate higher rates of return, the difference between all the different asset classes, stocks, options, futures, forex, crypto, what they're best suited for, and trading for income versus wealth management. So we'll teach you a lot more about trading at a professional level. It's fun, it's free, and if you're interested in becoming a Trade Phantoms Pro member, we'll have a special opportunity for new members to enroll. If you want us to teach and mentor you and trade live with you, you'll have a special opportunity to enroll as well. All right, I'm going to hop over to TikTok though, guys. For those of you who follow us on TikTok, come check us out over there. And that's it for YouTube for now. Take care, everybody.